Welcome to a new era of personalized investing, where private investors understand that true value lies beyond mere relative performance. Amity recognizes that investing is a deeply personal journey, and success is not just about numbers. Discover a refreshing approach to investing that prioritizes clients' goals and well-being. Unlike ordinary investment options, we are dedicated to a true outcomes-based strategy, bringing certainty to investment outcomes. Don't settle for the ordinary. Embrace the future of predictability and certainty with our outcomes-based investment approach. At Amity, we believe in delivering personalized solutions crafted specifically for advisors' clients, understanding their risk appetite, goals, and preferences. Join us now and unlock the potential of a more rewarding and fulfilling investment experience that goes beyond the mere performance and places the client and their aspirations at the center of everything we do. Reduce uncertainty with outcomes-based investing. Amity Investment Solutions.
Welcome everyone to the last episode of our 4-part webinar series. It has been quite an interesting 3 weeks. I think we've all learned a lot and we've had some excellent speakers delivering excellent presentations and very valuable content. We again like to thank Think Capital, 361 and Anchor for participating and sharing some of their insights on this topic of hedge funds. And we hope that you are all now masters in this topic of hedge funds. But we thought it would be great to end off the webinar series featuring one of our own today. And with me in studio is Vian Dahl, and he's one of the analysts at Amity. And it's great to have him here, seeing that it's always difficult to get the guys away from their desks and their spreadsheets and their programming. But Vian has been with us for almost now coming up 2 years, and he's been in the industry for quite some time as well. And recently, Vian has done quite some extensive research on the topic of hedge funds. So I thought it would be great, firstly, to maybe share with you all our position and our take on hedge funds, our opinion on whether it can fit into the Amity model range and how we specifically look at model portfolios and investments, seeing that we are an outcomes-based DFM. And then also to maybe share just with you his findings, his overall findings in terms of hedge funds. So thank you so much, Vian, for joining me today and sharing with me the research that you have that you've done. So I thought to maybe start off with maybe let's call it a bit of a fact or fiction session. And one of the things that we've picked up listening to some of the speakers was that a lot of advisors select hedge funds for most probably the return element. And a great way to maybe start off today's session is to take it from a different angle. And I mean, you have actually, we're going to show this slide now, the efficient frontier that you have on here. Tell us a bit about your take on hedge funds when you look at this specific efficient frontier.
Well, hi Tanya, thanks for having me. Well, if you look at the first slide, you'll see there's 3 different kind of curves. And I like to point to them as envelopes, right? So the black curve would be the traditional asset. So there's 12 different kinds of asset classes there, or market indices, all in Rand. And what happens is when you build an efficient frontier, you essentially simulate all the possible portfolios that you could have constructed, given your length of your data set. So the data set we have here from 2019 to 2023. And essentially the idea is that anything within the envelope, so above the bottom line and below the top line, any of those combinations of assets would have been inefficient when you consider the amount of return and risk that you would have gotten from that combination. Anything on the top line is the efficient frontier. So it would be the highest return per unit of risk that you could have achieved, right? And the lowest line would be the most inefficient, right? The kind of very low return, high volatility portfolio that you don't want, okay? Anything outside of the envelope would be impossible. Returns that you could not have achieved given these assets over that period, okay? Next thing we do there is we add in the hedge fund curve. So what we've done is from Hedge News Africa, we've taken, I think it's about 8 or 10 different indices, and we construct that efficient frontier. And then the next one, the blue one, would be the combination of the two. Now, the first thing you realize is that for a lot of the higher return, lower vol, the hedge funds tend to outperform, right? But there's also some inefficiencies in that. Some of them tend to underperform the traditional line, the bottom of the envelope of the traditional curve, right? And that's essentially adding some inefficiencies. So yes, while hedge funds can add higher risk-adjusted returns and superior returns, they sometimes can add inefficiencies. And this is the problem of choosing how to allocate to a hedge fund, whether it be the strategy or the manager in and of themselves. All right, and I'm just going to skip over to the next slide. You can see there I've pointed in some lines to say, well, inefficient and impossible, just above and below that line. And the difference between the black line and the blue line on the top of the plot would be where you added some efficiency. So you've increased the units, the return per unit of risk that would have been possible if you only had traditional assets. So from that, you've gained some efficiency, right? But you've also lost some efficiency on the bottom of the curve, right? There were some returns that were lower for higher vol relative to the traditional assets. So we have to consider how an inclusion of a hedge fund can either improve your risk-adjusted return or lower that. And that comes with the difficulty of selection and allocation through time. Yeah.
But you did mention superior returns. Do you kind of think that hedge funds offer superior returns in all markets every time, spot on?
Well, what you can see from this curve is of the last 5 years, there were a lot of hedge funds, a lot of strategies that could have provided superior returns given market conditions. But there are also some that would have detracted from that. So yes, while it is definitely possible, adding an alternative strategy or an alternative investment style to your traditional portfolio can produce superior returns over different market conditions, it's also possible that you might detract from that. So whether that's a consistent relationship, whether the hedge funds provide superior returns over all market conditions, isn't necessarily true all the time.
Okay. And then you did touch now on the risk-adjusted side. So let's maybe focus on the risk. And I think it's one of the topics, or your next slide as well, where we talk about different metrics, the probabilities, things to consider. Now, maybe let's take that a step back and say that a lot of times advisors or most industry participants, we refer to risk in the industry almost always just standard deviation. But in fact, and we've picked it up when we did the outcomes-based scorecards as well, there are various other metrics that actually should be considered. I mean, when you and I had some prior discussions with this, we talked about exactly low vol. Does it mean low risk? Is that the only way you should then refer to risks within hedge funds? So maybe take us through your thinking in terms of risk metrics for hedge funds.
Well, definitely. So let's skip over to the next slide. Well, from the previous slide in the efficient frontier, we saw that risk per unit of standard deviation can be improved. And that's really because hedge funds have a lot of a lower vol profile compared to more traditional asset classes, right? The problem is that there's more risk that you could be adding in. So there are 4 moments to a distribution, right? You have your mean and your volatility. Those are the 2 we generally consider. But you also have what's known as skew and kurtosis. So the skew is how long either tail is, right? Does the distribution lean negatively or lean positively, right? And the idea behind that is that if you have large negative skew, right, it means you have a long left tail, which means you increase the frequency of negative returns, of higher losses, right? Whereas positive skew
and frequency, it's actually, so you're saying that there are more times now for your client to actually get these negative returns.
Exactly. So the risk is there that you could have a larger loss more frequently than you would otherwise, right? Where positive skew is the opposite. Positive skew means you have a longer right tail, which means you have a higher frequency of higher positive returns. Hedge funds tend to have a large negative skew. And this is one of the risks that you add in. So if you think about traditional assets, think about cash, specifically South African cash. You can see from the table I've plotted there, that South African cash has a high positive skew. Now, why is that? If you think about interest rates of the last decade, right, they tend to move down. Think about 20, 30 years, they tend to move down, which means 20 years ago, your average return to cash was higher. So what happens is, if you take the full history, your mean is actually moved in from the right, which provided positive skew, which means there's a higher frequency of positive returns. Hedge funds have the opposite, right? Hedge funds have a higher frequency of negative returns, but a lower volatility. So you add in this new risk, okay? The 4th thing to consider is kurtosis. Now, kurtosis says, well, how fat are those tails? How large are those tails, right? A high kurtosis means that the distribution has larger tails, right? And it means that there's a higher possibility of extreme returns, but both positive and negative. So you could be adding more risk to your portfolio by having higher kurtosis. So while hedge funds have a lower volatility and they might diversify away some of your vol risk, they add in other risks, okay? And volatility in and of itself is not necessarily an efficient risk measure. That's because you have two kinds of volatility, positive and negative. Positive volatility is efficient, right? You have a higher vol on the right side of your distribution, so you tend to move from your mean to the right positive side more frequently than you would to the left. Problem is with volatility, it takes both tails into account. So while it may affect your consistency and possibly your investor behavior and experience, it's not necessarily a very good risk measure to consider. So hedge funds, just in general, tend to add other risks that aren't normally observed.
So maybe we should move on to the slide next, where you actually showed us these distribution curves, because this talks a lot then about the behavioral side. So what we see on this is that you have your negative one, you have your normal distribution one, and you have this positive one. And so the middle one, the normal one, what type of portfolios would typically, is that your diversified portfolios typically that you find in there?
Yeah.
And negative, would that then be your hedge fund one?
Yes.
And then what do we typically refer to in the positive side? Is it cash, defensives, or what do you find in that specific?
So defensive assets can have a higher positive skew because they have a high frequency of these income returns, right? The more you go up the duration scale, so the more risk you take on duration along the yield curve, the more volatility there is, but also the more chance of frequent negative losses due to changes in interest rates. So what you'll find is cash will have a very high positive skew. Then flexible income from the 3-year to the 7-year on the curve will have less of a positive skew, but positive skew due to that income stream. Yes. While as bonds with high duration, because they can have large capital losses due to increases in interest rates, they tend to have more of a negative skew.
So then it becomes quite an interesting behavioral discussion, because now you sit with a lot of advisors that from a cost side would like to choose passives or trackers. And now you have the opposite of it, being the higher cost structures within hedge funds. And also then from just this table or this slide, you have advisors again wanting to go into cash for this low risk, but willing to take on hedge funds with a completely different profile. Do you think it makes behaviorally sense then to have this, or what's your take on the behavioral side of the hedge fund industry then?
Well, I think let's point back to the graphs there, right? So the middle graph is a normal distribution. Now, when we talk about a normal distribution, we say, well, you have a mean of 0, standard deviation of 1, skew of 0, and a kurtosis of 3. So when we say we assume normality, what are we actually assuming? We're assuming that your skew is 0 and your kurtosis is 3, because we can allow the mean and the variance to change, right? Okay. So your diversified portfolio would be more normally distributed. The minute you start adding other risks like skew, so you add negative skew, now that'll be the graph on the left. So skew goes from 0 to negative, right? Behaviorally, what the client is feeling is these large negative losses more frequently, right? So if they're very risk averse or have a low risk tolerance or low risk capacity, then that would affect their experience through time. It could affect the way they feel about their investments and how secure they feel in that investment. Well, if you can move towards a positive skew, you tend to get this premium on top of that, right? Clients like to see, oh wow, this month I made a lot more than I made last month. And if that happens relatively frequently, they have a better experience through time. Yes. And this helps smooth their behavior. So to prevent switches, for example, we know frequent switching can reduce the expected return for a client over time, right? So behaviorally, really what we try to do is you either want to move to a normal distribution or you want to skew it to the right. Now, when it comes to passives and things, a diversified portfolio of passives, even long-only active portfolios, could tend to normality. And that's why we tend to say, well, mean and variance is enough when you appraise the performance of these long-only funds, right? The minute you add a hedge fund, you start to add negative skew. But we also know that you diversify some of your other risks. So yes, your volatility will be lower, even though you might be adding negative skew, okay? It really depends on how large that change is. So you can have a very small allocation to a hedge fund without adversely affecting your skew or kurtosis, but still reducing the volatility, possibly increasing that mean, right? You could actually find that by adding more hedge funds, you tend towards more normality than you did with only traditional assets. So it's really about the way you group these investments together and how you weight the different allocations through time. Yeah.
And now you did mention about appraising the managers, and I think your next slide actually shows quite nicely as well the difficulty you guys have with analyzing hedge funds. and difficulty in the sense that there are finer nuances when considering hedge funds. I think one of the previous discussions you and I had, you mentioned in terms of the asset class, we do asset class characteristics, but hedge funds can't just be almost like group, there you go, it's a hedge fund, how does it, because of all these finer within hedge fund structures. So I think that was one interesting point, and we've heard from, I think it was Almin in one of the webinars she did, where she mentioned to be very, to ensure that you aren't mistaken the strategy with the naming convention and the type of let's say the structure they use. But let's talk then about when you did this research, what was some of the difficulties? I mean, is it difficult to rank hedge fund managers? Are there issues when appraising a hedge fund manager? And even if we take it a couple of slides back, you mentioned efficient frontiers, but let's talk about efficiency in a different way. How efficient are some of these managers? So maybe take us through the slide that you guys looked at.
Well, following on from what I said earlier, right, when you appraise a long-only manager, we tend to assume normality, right? So a Sharpe ratio is just your excess return about some risk-free rate divided by the volatility. So you use the first and the second moment. Now we know that a hedge fund tends to have slightly higher mean, lower vol. So from your regular Sharpe ratio perspective, they will always outperform or tend to outperform, right? But we know that if we adjust for other risks, that might not necessarily be true. Okay, so when it comes to appraising a hedge fund, right? Another thing to consider would be that the strategy indices we use from Hedge News Africa, for example, those are median manager indices. Think of it more of an ASISA category. Now, what happens is there's a lot of dispersion within those groups, right? And this is what you mentioned earlier about sort of confusing a manager's category style with what you see in these.
Almost in their structure or in their risks and in their classifications.
More the classification,
okay,
yeah.
Okay.
Whereas long-only managers, for example, if your benchmark is the ACWI, that is your investable universe. So all the managers that would have the same benchmark, you would find relatively small dispersion within them. This is why it's very difficult to beat those benchmarks, right? Because you're very constrained. Whereas the managers in the hedge fund tend to have very large dispersions, okay? And because we can't use just the first moments, we have to use all 4 moments, your traditional measures don't work anymore. Okay, and you can't necessarily use the indices as benchmarks for them to beat, because when you average out between every manager every month, it really smooths that profile, right? So there's a lot of information you're missing. So what we did is we scoured the academic literature and we found something known as data envelopment analysis. And it's essentially just a mathematical tool that allows you to take a number of decision-making units or inputs and determine how well does your manager minimize those inputs to maximize the outputs. So what we've done is to account for the risks of the 4 moments we discussed. We found this paper where they suggest that, well, a hedge fund has a minimum acceptable return of cash. The reason being is because a hedge fund takes on margin, right? They take on leverage. And what happens is you put some cash into a margin account and you're paying interest on that margin, right? To be provided with that leverage. So there's a cost to margin, right? And that's obviously associated with the level of interest rates in the country. And there's also a foregone opportunity cost, right, of a risk-free return to cash. So what we do is, well, there's a minimal acceptable return of cash. Now we think about our 4 moments again. If you can divide those moments into 2 separate halves, right? So what is the mean below the cash return in a manager's distribution? What is the variance, or the semi-variance below that return? And what's the semi-skew and what's the semi-cortosis? Right? And if you think about everything below that minimal accepted return is a risk the manager has chosen to take. So it's a decision. It's a decision-making unit, an input to what they're trying to produce an output, which would be an excess return. Okay? So if we take those inputs, and similarly we take all the semi-moments above that minimal accepted return. So what's the mean above cash? What's the standard deviation above cash? Skew, cortosis, above cash, right? If we can determine how well a manager can minimize those inputs, the lower partial moments, to maximize his outputs, which are his higher partial moments, we can determine if the manager produces risk-adjusted returns in excess of that minimal accepted return in an efficient manner. So what this method does is it determines 2 kinds of efficiency. One is just its normal DEA efficiency. It's a value between 0 and 1. A value of 1 says that it's efficient, right? Anything below 1 is inefficient. Then super efficiency is the ultimate or absolute ranking mechanism. What that does is it also takes input, output, maximizes, determines a score, but it considers, well, how well do they do that compared to every other manager? And we can do that within strategy group. So now your benchmark becomes the manager's decision making, right? Some kind of minimal accepted return, their output, and the performance of every other manager using the same technique.
And maybe we should just highlight this because it's quite important that a lot, well, I'm saying a lot, maybe it's all of the managers use cash as a benchmark. And it feels almost inherently wrong to think of hedge funds comparing themselves to a cash benchmark. But you are now trying to explain why they use cash as a benchmark and why this is inefficient, and you'd rather go with this method. So maybe that's just something we should highlight to the audience. But yeah, so you have now considered inefficiencies and efficiencies in terms of this model.
Yes, 100%.
Okay, and what was some of the findings and the ideas behind it?
Well, if we can go to the next slide, what we've done is we've created two subsets of managers. Out of the 5 strategy or category groups that we chose, we find that these are the most, they have the most representation. And they're the easiest to understand, and probably from these 5 categories are the ones that are most suitable to your general investor. Okay. From there, what we did is we bucketed them into the efficient and inefficient funds. So those with a score of 1 for efficiency, and those with a score below inefficiency. And what you find is the majority of the managers in those strategy groups are actually inefficient, right? A very large percentage of them, I think at least 1 or 2/3 is inefficient. Now what that says is it's very difficult to find a manager with high risk adjusted returns that account for all the risks that we identified earlier, the risks that aren't normally considered. Okay. Then what we did is we said, okay, well, what are the historical return and risk figures for those different groups, right? And what you'll find is the efficient groups, for example. The average upon all efficient groups for every strategy is higher for efficiency than it is for non-efficient funds. Okay. The standard deviations are very, very similar. In our example here, they're actually higher for the efficient funds. What we'll see just now is that higher vol is efficient. It's more efficient than the lower vol. And why? Because you have a lower partial vol and a higher partial vol, like I explained earlier, right? Next thing you see is that the efficient funds have less negative skew, and they have lower kurtosis.
So again, less frequent negative returns.
Large negative losses,
Okay.
exactly, 100%. And then the kurtosis is also smaller, which reduces the probability of extreme returns, right, reducing risk. The next thing you'll see is that the rolling 1 year, the minimum rolling 1 year return for those strategy groups is slightly higher or slightly lower for the efficient funds, right? But if you then compare it to the maximum 1 year rolling returns, the positive returns, right? It's about twice as high for the positive returns, while the minimum returns are very, very similar. So if you have to just think about the efficiency of reducing downside and optimizing upside, this tends to bucket them into highly efficient funds. Similar thing when you look at Sharpe ratio. Sharpe ratios are much higher, and your expected tail losses are much lower. So accounting for all those risks that aren't classically considered for traditional funds, right, we can really bucket these managers into those that add a lot of efficiency and those that don't.
Maybe just, maybe it's a unfair question and you can answer or not, but why would hedge funds require these other risk metrics? What in them, what instruments in them or underlying ways of the managers looking at doing a hedge fund is causing this, that you have to consider these additional risk metrics where you're long only not? Is it purely the leverage positions, or is there something else that you've found, or the reason for this?
100%. The amount of leverage they use, right? So when you use derivatives, you get what's called an asymmetric payoff function, right? Essentially, it's highly non-normal, and we've seen that from the distribution statistics we've showed now. And essentially, the manager can normally control how much downside risk he takes much better than a long-only manager can, because he can put longs and shorts in place. So he knows, well, if the market was to fall a certain percentage, my long position might make a loss, but my short position will make a gain. Therefore, he can limit the amount of risk there is to the left, right? Similarly, he can maximize how much return he gets on the right, because he can leverage up the possible positive returns. And that's why we have to consider these other measures. This is why they have different risks to consider than long-only managers, because of the way they can actually manipulate the returns distribution to provide a specified kind of outcome. That's really.
This is also leading to a discussion point we've had off camera, where you mentioned that a QIF and the RIF and the differences that you should be aware of given this leverage? Maybe just highlight that specific differences.
So with the RIF, because you need daily liquidity compared to the QIF, right? This is one of the requirements the FSCA gave these hedge funds to be able to open these retail kind of investments, right? They need to use less leverage, and less leverage means they have essentially more cash on hand, and they can price these products a lot easier. And essentially what that does is that the QIF, because it uses stale prices, right? It doesn't have it doesn't update the prices as efficiently as, for example, long-only manager, where the market really determines the price. The kind of instruments they use need to be priced using multiple different kinds of quantitative models. Now, because the RIF needs daily liquidity, they need to price faster. Okay, that means that they will probably have a lower return because of less leverage and possibly a higher volatility, right? Due to this less stale pricing that sort of fold into the returns distribution. So what we have to remember is that the RIF might make less return for higher vol, which means the Sharpe could be lower than the QIF could be. So there's something to consider when you analyze or appraise these funds. Is, are you using the RIF or the QIF? And if there isn't currently a RIF available, then you have to sort of, I don't want to say penalize the QIF, but just understand that there might be some inefficiency in the data that you're calculating from that QIF.
Okay. We're going to show a slide now which was a bit debatable in terms of when you look at it from face value, it looks like, oh wow, but these hedge funds actually do much better than the CISA categories. Or you just followed the green lines and then you have, that's what you want to think. But there are some interesting things that you can pick up from this slide, and we've highlighted in the 3 blocks below as well. Firstly, some other risks. I mean, you've touched briefly on some of the other risks that you don't typically see in here. Qualitative risks, some things that we haven't chatted about yet. So maybe take us through this slide firstly to show from a face value, it looks as though hedge funds tend to perform well and do better and should be used in portfolios. But then share with us those finer things that we often miss, especially advisors. What's those missing factors then?
What I've done here is I've taken the Hedge News Africa indices, which are median manager indices. I've compared them to a CISA categories, which are also median manager indices. What I've tried to do is compare them with, compare each category of the hedge funds and the long-only funds as closely as possible, right? And what you find is, for example, that generally the hedge fund average manager tends to have high return, less volatility, more upside frequency. So the percentage of months that they provide positive return tends to be somewhat higher, right? It's really when you get into the risk-adjusted measures that we have to be careful. So I've provided 3 different kinds of Sharpes there. The first Sharpe is just your excess return divided by your standard deviation. Now we know because they have high return, lower vol, they tend to have higher traditional Sharpes. The second one, I took the denominator would be the value at risk. So if you had to take all the returns in your track record, if you had to sort them in descending order, right? You find the average of your 5% worst returns, right? And that'll be your value at risk. So on average, what's your 5% worst expected return? The last one is your modified Sharpe. Now this uses your expected tail loss as your denominator. So it's very similar to the value at risk I just described. Just what this does is it penalizes it for having higher kurtosis. So if we know that kurtosis means that there's a higher chance of having extreme negative returns, then we need to adjust that value at risk slightly. And what you find is there, and you can see it in the top right column of the table I provide, is that suddenly it underperforms, right? And that's not true along all these categories, but you can see it specifically for the equity guys. So when it comes to expected tail loss, it adjusts for that hidden risk kurtosis. They underperform your traditional long-only manager when it comes to those kinds of risk-adjusted returns. So when you make a decision on how you're going to invest, you really have to consider, well, do my metrics account for the correct kinds of risks, or do I need to use more modified, less traditional ways of doing that, similar to the DEA analysis that I showed earlier? It's a less traditional way of doing it, but accounts for these higher order moments, higher order risks, right? Other thing just to consider there would be that, yes, the green lines are mainly the hedge funds that tend to outperform in most of those risk measures, and even for the multi-strategy and the fixed income guys, they still do better on your modified Sharpe. You still have to just consider, how are you going to blend these two things together? Because it's not to say that, well, just because the fixed income hedge fund median manager outperforms the median fixed income long-only manager, that you should only go hedge funds. Well, no. And we know that because they also don't always outperform in all market conditions and everything else we've said. So you really have to try and find a combination of these two. And that's really where you're going to find better risk-adjusted returns, by diversifying that portfolio.
So maybe from a qualitative aspect, let's just briefly touch on some of the other risk issues. Something like the nimbleness of a fund, or they have to soft close in some instances. They are the fee debate that we often hear guys chat about. Share with us some of those qualitative risks that you think that's also something that we need to additionally consider.
Well, we have to consider one thing, is that we know from academic literature that a higher AUM in a fund tends to lead to more underperformance, right? Because yes, they're less nimble, they have more assets or more cash to invest with. That means that their best ideas, they can't always leverage the highest, right? Specifically long-only managers. When it comes to hedge funds, they might be able to add a bit of leverage to these best ideas. They won't need all that cash because they're using it in a margin account necessarily, right? But sometimes they have a much smaller universe than we might consider, especially the fixed income guys. Fixed income guys here aren't necessarily only trading government bonds; they're trading private debt and all other kinds of credit, right? And what happens is, if that pool is lower and you have a larger set of hedge funds with growing AUM all trying to play the same strategy, it means that there aren't enough of those instruments, or at least enough liquidity within those instruments for them to all play that same kind of strategy. So that's why a lot of them tend to soft close, because there's a limit of AUM that they can reach, that suddenly their strategies might underperform, might be at risk of underperforming, right? So AUM becomes a very important consideration. The other thing is fees. So a lot of the academic literature we find says, well, having performance fees can actually provide incentives. And I know we've all heard the story before, but there's a lot of literature to back that up. It provides an incentive for a manager to outperform because he expects to have a larger paid day from that, right? But he also knows that if he takes too much risk, he might risk the returns he's already made, right? So he might not necessarily have to scale up more risk to get that higher return. So it can lead to better risk-adjusted performance.
So it does seem to be then you've touched on some hidden risks, you've touched on other risk metrics, we've touched on qualitative risks. And something that I do think that we should also maybe refer to is how difficult it is to try and analyze this by yourself. If you're an advisor, your main role is to see your clients, service your clients, and now you have to make these decisions, because it's now not just looking at two fact sheets and trying to pick the best in terms of the basic metrics that they typically provide. So I do think when you consider this, and perhaps it's more of personal view, it becomes a challenging task for an advisor out there to try and select which hedge funds they should consider. And maybe a point as well is that, like you kind of alluded to now, you do diversify your portfolio. It is a nice way of diversifying some of the return sources when you include hedge funds, but to combine the long-short type of mentality. And I think it was something that 361 alluded to last week as well in our session, is that you have to consider the long-short mixes as well. Now, I'm going to show this slide for just in terms of our outcomes-based range. We obviously, as we've mentioned, we are DFM. We manage exclusively actually outcomes-based model portfolios. And then we also measure our outcomes-based portfolios on 4 pillars. So we measure and monitor it also slightly different than your typical DFMs, your typical Cat 2 managers, etc. Now, where will a hedge fund fit in, or could it potentially fit in to an outcomes-based model portfolio?
Well, definitely, right? So if I have to consider first, if we look at your slides, let's consider the income funds on the left. Well, we know specifically for the last year or two, right, that income funds are highly sensitive to changes in interest rates. So adding a hedge fund, someone who could trade interest rate volatility, could help smooth that sensitivity or that return profile through time, right? What it could also do is that by lowering your volatility and slightly increasing the return, what you might be able to achieve is reducing the ruin probability of an income fund. So if you're an investor and you're drawing an income from an income producing product, right? The horizon that investor has, right? So the decumulation period, along with the starting withdrawal rate, the escalation in the withdrawal rate, and obviously the principal investment at the beginning of the period. All of those you need to consider when it comes to a ruin probability, right? So the longer the client's horizon, the higher the initial withdrawal rate, the higher the escalation rate, right, the higher the ruin probability of that investor. Now, what that means is the ruin probability would be the probability of not reaching the end of their horizon.
So it's almost like longevity risk for...
Yes. Yeah, well, longevity risk, obviously, if you have a very long longevity and a long horizon, that also makes it riskier for you, right? So if you were to include a hedge fund into these kind of portfolios, increasing your mean and reducing your vol could improve your ruin probability. So it could lower the probability that you don't achieve that goal through time, specifically because they can trade rate volatility and decrease overall portfolio volatility. But you have to consider that if we know that they add negative skew and they add positive kurtosis, we know that you can have more frequent large negative losses. That increases your sequence risk. So it could be that, yes, in your simulation over a long period of time, the higher probability of more people sustaining their income through time. But it could mean that a lot of those investors that invest at an early point have a large negative loss early in their decumulation phase. And that could then make their ruin probability shoot up. So you have to consider how much or what's the marginal impact of adding a hedge fund to that kind of portfolio when it comes to reducing your ruin risk and possibly increasing your sequence risk.
And I think on our income webinar, we specifically refer to sequence risk, and maybe again to highlight the definition there and or illustrate it in the sense that the order in which your returns happen can become very crucial, especially for client withdrawing or having a liability against that portfolio. So in essence, you're saying that consider almost the suitability aspect here. Consider the type of client, consider the type of products, investment horizon, etc. So if we look at our slide here and we look at that income, it can fit into the defensive buckets, but perhaps not necessarily in terms of a living annuity client withdrawing too much over a short investment period.
Yes, 100%. Obviously, the lower the initial withdrawal, the higher the principal, right? And the longer your horizon, the less your sequence risk becomes an issue. But if you have a client with a relatively small horizon who's drawing a lot from the beginning, adding a hedge fund and increasing sequence risk could be detrimental, right? And that could lead to a high ruin probability for that client. So it's very, very important you consider each client's respective situation, right?
And then if we maybe move on to this next slide where we show the 4 pillars, and we often talk to the guys, and this is how we monitor and measure and look at our outcomes-based model portfolios. There's one aspect that you've touched on briefly now as well, or earlier in the session, is consistency. Now, consistency is one of the pillars that's very important to us. So perhaps delivering the outcome, potentially your hedge fund can deliver better rand cent value at the end of a rolling 3 or 5 year period. But considering consistency, it seems that with exactly what you talked about, skewness now, that those frequent or those more regular negative returns can actually impact our consistency measure. And that could, for us as an outcomes-based DFM, looking at consistency, be an issue.
100%. Well, when you think about consistency, first thing we have to think about is volatility, right? If you have a high mean and a low volatility, then you tend to have more of a consistent return around that mean, right? Obviously, you can be affected by a large negative skew, right, when it comes to consistency. Mainly because then in certain periods, if you have a high negative loss, if that correlates to the market also having a negative loss, you have a whole portfolio that has a loss, and that reduces consistency. But we do know that having a very diversified portfolio, it could be that, well, if a hedge fund manager experiences a large negative loss now, it could be that the long-only assets produced a high positive return, right? Which would actually result in consistent return. So it really comes down to the diversification of all these different kinds of risks. You can improve on the outcome rand cents through time. You can improve on the consistency depending on how you basket these things together. All of that's possible under the right consideration of asset allocation and obviously manager selection. When you consider that, obviously, you have to take in all the possibilities, right? All the different risks that you add and all the different risks that you could be removing through time, simulate those through time, see how they react when you include these alternatives in. They could obviously increase risk, like we've said, but they could also help manage risks. Again, what's the marginal impact of an allocation to every hedge fund or a single hedge fund or strategy on that risk, right? And that's where it becomes really difficult. Just understanding what that marginal impact is and the size of that allocation through time on delivering these outcomes, on improving consistency, on preserving capital, for example. All of those things, it's really how you blend them together. That's the most important part.
And that's maybe a nice way to end our discussion in that sense today is when we are questioned by advisors whether we will select, often we get the question, will you consider passives or active? And we say it's not a question of or, it's a question of and at the right time and given certain metrics. But I think you kind of establish it now as well that Amity has the same view in terms of or on hedge funds. It's not a question for us of a or, but rather where will it fit in, when will we use it, as more information becomes available, as perhaps certain of the issues that we typically pick up, the transparency issues or maybe reporting or anything like that in terms of the hedge fund industry, it becomes easier for analysts like yourself to start to incorporate these and do the research and know where to use it. So maybe that's a nice way to end off our session today. We have discussed some of the lingo again. We've talked about leverage. You shared with us how margin accounts work, which I think is a great way. And I'd like to thank you for doing this research and sharing it with our audience today as well. And for everyone that attended the 4 weeks, thank you so much for attending it. Maybe if you are watching this live, remember that all the recordings will be made available on our YouTube channel as well. If there are any questions that you think you would like to ask us, or even have us refer to those questions to the panel that we've had on here, please do so. And then until our next webinar, we hope you all keep well. Thank you.